Welcome back. So before we took a break, we briefly discussed uh, almost all the background, scope and everything. Now let's jump on to the clause by clause paragraphs. Screen is visible, right? It's moving. So clause 1 and 2 otherwise simple, nothing much to discuss except one word of caution. Sometimes what happens is there is a change in name or change in address after 31st March 2026, say for example. Then what do you do? Thank you. So under such cases, one has to ensure that the address which is given is, or the name which is given is the current address or current date, or the date on which you are signing the audit report. So again, nothing much as far as name and address is concerned. Registration under indirect tax law. Now here there are high possibilities that we may miss few registration or we may misinterpret some registrations. Typically, I have seen people are reporting profession tax and not reporting import export code, IEC code, which is actually not right. Why would I not required to be reporting profession taxes? Basically, profession tax is not an category which is indirect tax, though managed by GST or VAT department or indirect tax department, but is not within the category. Therefore, profession tax number is not reportable. Whereas as far as IEC is concerned, import exporter code is concerned, which deal a lot of about custom duties, import duties, those are typically indirect taxes. Therefore, IEC number, if any, has to be reported. So this is something which one need to be careful when you are reporting this under this paragraph. Now, in general, it is understood that GST would come, but there is a high possibility that in few cases or few SSEs, VAT or excise still may be there for certain specific products. Therefore, be vigilant and alert to include even those numbers as well. Status, very simple, except in a situation, in case of an individual, if he is passed away, then what do you report? So one has to be careful there. Legal hire or authorized representative and all those categories will have to be considered while you are reporting status and not individual specific. 8A clause, exercising the option of concessional tax regime. Again, otherwise as such simple, but there is an only possibility because the SSE has right or option to exercise this option before filing tax return, and on the date of filing tax audit, there is a high possibility that SSE would not have opted for that option. Therefore, under such scenarios, appropriate clarifications or disclosures have to be given under this paragraph, if one should keep in mind. Clause 9, name of members, partners in case of AOPN firm. Typically the heading is AOPN firm, but definitely LLP also will be included because it is considered to be a firm as far as income tax is concerned. Therefore, even LLP will have to be considered for reporting these clauses. Loss sharing ratio also will be reported. If there are different different ratios for profit and loss, both have to be reported under this paragraph. Remuneration sharing also could be there as a part of deed. Whether that will be reportable, the answer is no. because it is remuneration and not profit share. This clause restricts itself to profit sharing ratio, which includes loss as well. Therefore, any remuneration sharing ratio, if any, should not be reported under this clause. Now, change in members or change in partners. Typical example could be that a partner earlier or a person earlier was representing in the authorized representative capacity, and now he actually becomes the partner. Whether that will be reported? Yes, because under both situations the status was different for that individual. Therefore, even those changes will have to be reported. Now, at the beginning of the year, we had partner A, B, and say 50-50. In between, the firm admitted C, the ratio went say 33-33-33. Further, C retired. Ultimately, the ratio, ultimately at the year end, only two remained again in 50-50. So whether the position was not different, what was on 1st April and on the last April, then whether all those interim changes have to be reported, the answer is yes, because it expects all the changes happened during the year, and tax audit report is for the year and not as of 31st March. Therefore, all the changes happened in the interim period also will have to be reported. Nature of business profession change, if any. One should not get confused in terms of expansions scenarios. Like if there are expansions or extensions of the existing business, then those are not change in the nature of business or profession. It has to be actually a change in the nature of business or profession. Therefore, while reporting under this paragraph, these specific fine differences will have to be kept in mind. So basically, when typically a new line of business is added, yes, it will be reportable. Books of accounts, clause 11. Now, which is subdivided into multiple categories: books of account maintained, books of accounts examined, and books of accounts prescribed. Now, not necessarily that under each three category there could be same books of accounts. There is a possibility that books of accounts would have been prescribed but may not have been maintained, would have been maintained but may not have been examined. Therefore, while reporting under this paragraph, be careful at what are we reporting. Typical problem these days is a lot of books of accounts are maintained online, say Zoho books or QuickBooks or those kind of things. So under this paragraph, address has to be mentioned that where those books of accounts are maintained. So in case of an online scenario, which address do you report? Whether the office address? The answer is no. Appropriately, we'll have to make sure that we make disclosures that these are accessible from the office, but the accounts are maintained online. It is mandatory that we mention IP address where these accounts are maintained. Therefore, please be careful in case of SSEs who are maintaining online books like Zoho or QuickBooks or any other such tools. So in that cases, we'll have to report the IP addresses where the books of accounts are maintained. So those are records in general, but now with GST and everything, actually what happens is it forms an integral part of books of accounts. Therefore, I would tend to say that inventory register is actually a books of accounts, because a lot of information is actually directly linked to my financial books. So with my inventory records, my purchases would be linked. With my inventory records of outgoing, my sales would be booked. So I would tend to include inventory register as my books of accounts. And as I said, now with GST, where it is mandate that you have to maintain all the quantitative details, it becomes an integral part. Now that we are talking on this quantitative details as far as GST is concerned, let me cover the clause 35, which requires for quantitative details of, I'm just jumping because we are on that topic. So there is one clause which requires quantitative details in case of trading entities and manufacturing entities. Now we typically, chartered accountants had a habit to simply say that SSE is not maintaining quantitative details, year-end inventories are taken, and basis the inventory taken by the management, we have reported so and so forth. But I think now with this GST regime, in my view, it is really difficult to report this way, because GST is mandating to you to maintain all these records. So if you're, and you have to make sure that if you are not, if somebody is really not maintaining, then you have to also make sure that similar non-maintenance is reported in GST as well. And I don't know the repercussions there, that under GST records, if you say quantitative details have not been maintained, what will happen there? So one has to keep this quantitative details or inventory records very specifically in mind. Still today, I have seen a lot of tax audit reports where it says that quantitative details are not maintained and year-end inventory have been taken. But I see it is a lot of risky proposition, and you will see in coming slides where I have listed down the observations by TAQRB. They've picked up this clause specifically, and they've said this specifically, that in today's scenario, when somebody is saying that quantitative details are not maintained, is not acceptable. So they have also observed this specific issue. So otherwise it was very simple. We used to write year-end inventories have been taken, and we have only reported what they have taken. But I think in current days it is difficult. So method of accounting, again, typically there are two methods of accounting, or rather I would say three methods of accounting: cash, mercantile, or hybrid. One should not get confused between method of accounting and accounting policy. Any change in method of accounting is only reported here. Any change in accounting policies are not to be reported here. And as I said, method of accountings are largely cash or mercantile. Income tax department allows hybrid to some extent, but under general GAAP, accounting gaps, only two method of accountings are permissible: cash and mercantile. Therefore, as I said, any change in accounting policies are not reportable. Therefore, any change in depreciation method or any change in inventory valuation, all those are change in accounting policies, will not be reported here unless somebody is actually changed from mercantile to cash or otherwise. Closing stock. Very important aspect of closing stock, 145A, inclusive method versus exclusive method. Now we all know exclusive method is method where refundable taxes are not routed through P&L, they are routed through balance sheet, wherein GST credit or GST output liabilities, everything will be parked in balance sheet and not coming to P&L. Typically accounting standards, AS or Ind AS, expects the SSE to follow this. Therefore, most of the SSEs must be following exclusive method. Assuming if some SSE is following inclusive method, then at first place, I mean, I'm keeping aside this clause right now, but at first place, my audit report will be qualified saying that SSE is not in compliance with accounting standards, because now, today, accounting standards are applicable to all entities by virtue of various publications by ICAI. So, the immediate response to not following in exclusive method is the qualification of accounting standard. Now, while we are reporting for tax audit report, which expects that certain transactions have to be followed as inclusive method, does that mean that I'll have to maintain two separate books of accounts for income tax, which is in compliance with 145A, and exclusive method, which is in compliance with accounting standard? Answer is no. There is no need to have two separate books of accounts. You can very well continue to maintain exclusive method of accounting, because under Income Tax Act, it is not expecting you to rewrite the books. What is expected under section 145A is that while computing, as we do various adjustments as far as our computation is concerned, you adjust your opening stock, purchase, sales, closing stock under inclusive method and report whatever impact it is on the profit and loss account by following inclusive method. So this is the principal difference as far as 145A is concerned. So 145A expects opening stock, purchase, sales and closing stock to be inclusive of taxes, irrespective of whether those taxes are refundable or not. Therefore, Institute has prescribed one table or one chart where you do all the adjustments, that if you follow inclusive method, what would be your impact on closing stock, what will be impact on your purchase, sales, closing stock, so on and so forth, and come up with a number that whether there is impact or no. Typically, there is no difference as far as profit is concerned when it comes to inclusive or exclusive method. But it is important to maintain that reconciliation, that on what numbers we have concluded that there is no impact. So meaning to say, when we prepare that reconciliation of addition or reduction of profit because of 145A, those numbers have to be backed by proper workings. Typically, what I have seen is you will have a lot of numbers in that sheet. Last number, which is of consumption, will be a balancing figure. So please be careful. It cannot be a balancing figure. It has to be reconciled with. This is the practice which everyone follows. But you'll have to still report under this. So how do you report here? It has to be. That's the reason it has to be. Because you are following exclusive method, you have to provide this working. See, had you been following inclusive method, then this working was not required, because your profit and loss or financial statements are basis 145A. But since they are not, you have to make this working. Those have to be reconciled with the books of accounts properly. Now this clause 13 and clause 14 had a lot of impact, which could impact your numbers. So clause 13 also had reportings related to ICDS. Now quickly let me just run through the ICDS which are applicable and the conceptual differences between ICDS and AS or Ind AS respectively. So ICDS 1 is typically accounting policy. Now when it comes to AS1, the corresponding AS is AS1, which talks of prudence, which talks of you should generally do mark to mark, following conservative approach. But ICDS 1 is not following this principle, meaning all mark to marks, all conservative approach losses which you would have provided, if any, will get disallowed or may not be allowed. What does that mean? That as an auditor, we have a reporting responsibility under ICDS 1 if any such mark to marks or any such provisionings have been done. So those items will be having reporting under ICDS 1. ICDS 2 inventory, we did discuss inclusive exclusive method. So therefore definitely the closing stock value which is appearing in books and closing stock value recomputed for the purpose of 145A will be different. Typically the amount should be reported here. I'll come to little different discussion when we complete all ICDS, like if we report, what are the implications and where should one be careful while reporting. Construction contract. ICDS 3 generally recognize only POCM, whereas Accounting Standard 7 has a possibility of deferral revenue recognition method, depending on, like if there are early stage contracts, then AS7 you may have some liberty to not recognize the revenue, but there is no such possibility as far as ICDS 3 is concerned. So this is one area where one will have to be careful. ICDS 4 revenue recognition, again accounting standards allow both completed contract for services and POCM as well, but ICDS only talks of POCM. There is no such concept of completed contract method. ICDS 5, tangible fixed assets. We know different sets of depreciation methodology as far as books is concerned, based on useful life, but as far as tax is concerned, you only follow WDV method for depreciation. Forex gain loss, largely similar, not much different except for minor difference as far as speculative transaction is concerned, but again not very critical as far as day-to-day operations is concerned. Government grant, one major difference is when it comes to ICDS, any grants on capital assets have to be adjusted in WDV, whereas in books you have a possibility of treating that as a deferred income. Therefore, there can be a difference when it comes to government grant between the AS and ICDS. ICDS 8 securities versus AS 13 or Ind AS 9. Ind AS 9 fair value through PNL, OCI, all those things. Whereas ICDS does not permit all those things. Between AS and ICDS as well, now when it comes to ICDS, it typically expects this mark to mark of cost or NRV lower category wise and largely on FIFO basis, but when it comes to AS 13, you do averaging to determine profit or loss on sale of investments, because that is how it is required there. Therefore, there will be always a difference in case if there are sale of investments when it comes to AS 13 and ICDS 8. Borrowing costs, again a fundamental difference. ICDS says you capitalize until the date of put to use, because the concept in income tax is put to use, whereas books is concerned, it is ready to use. So there will be a difference always there in borrowing cost as well. Provisions, standard ICDS 10 and corresponding AS 29. Now when it comes to liability, ICDS says you have to book a liability when it is reasonable certain, whereas AS 29 says where you have to be probable. If the liability is probable, then you have to make a provision. So there could be a difference, because when you assess the liability from a terminology of reasonable, certain and probable, certainly there will be always difference, because something which is probable may not be reasonably certain. So there will be always a difference when it comes to provisions is concerned. Very surprisingly, when it comes to ICDS and when it comes to contingent asset, it allows, ICDS allows to book the asset if those are reasonable certain, whereas accounting standards say no contingent assets to be recognized. So again, there could be a mismatch. So these are few important areas where one will have to be careful, because there will be a lot of different accounting when it comes to books, when it comes to accounting standards vis-a-vis ICDS. Now let me come to a typical problem when you start reporting here. I'll just give one classic example of tangible fixed assets. Now depreciation as per books in accordance with accounting standard, and depreciation as per IT in accordance with written down value. Is this a line item to be reported in ICDS 5? The technical answer is yes, because you have provided depreciation as per books as per AS 10, as far as IT is concerned, as per ICDS 4. Typically, how do you see the computation? A normal computation, you start with normal profit and loss, add depreciation as per books, less depreciation as per IT. Now I've seen the problems of reporting here. Now if I report here and I do that adjustment as well, when it comes to intimations, it gets double. Similar problem will be in most of the ICDS, because you do a lot of adjustment in terms of your computation, in your computation, and this depreciation is the classic thing. I went in to see further कि अगर जो मैं सिर्फ इसमें ही करूं और मेरे कंप्यूटेशन में depreciation as per books और IT अलग से ना दिखाऊं तो क्या? But there is a problem there. When I saw the ITR 6 or 7, whatever relevant applicable, there is a separate line item for depreciation as per books and depreciation as per IT. Now if I club that reporting here in ICDS and I don't report there, again there is a misreporting. So I'm not sure how do you reconcile this problem. What we've done is, we don't report here, put a note below that there is this adjustment which is relevant to ICDS 4 or 5, but same has been appropriately considered in computation under this para. So many such challenges we will face while you report ICDS. Now ROU assets, those will fall here, but Ind AS, as far as Ind AS is concerned, but their reporting are different there. So one has to be very careful when it comes to reporting of ICDS relevant disclosures concerned. Yes, sir. We will discuss this offline. Sorry, but we will discuss this offline. But all of us feel that there is no difference. Institutes also say so, that there is no difference. So let us believe that there is no difference and go ahead. Right? But I can discuss this with you separately. They pick up from there. So technology has actually overtaken the fundamentals. Forms have overtaken the acts and laws, but that's how it is today, and you have to live with that. So you'll have to play around that. Even the SSC is not a problem. Therefore you'll have to make appropriate disclosure and make sure, at the same time you have to make sure that you are also not a problem, because as an auditor there are reviewers sitting on your head. Tomorrow they should not question you what action you have taken on this. So you have to be clear, you have to make enough, you have to maintain enough documentation for all these things. So as I was saying, what kind of typical common adjustment which could come in ICDS is mark to mark gain losses, which you would have provided. ICDS 1 you will report there. Fair valuation gains, FVTPL, OCI in case of Ind AS. Actually there is no specific ICDS, so therefore you do adjustments in computation only directly. Construction contracts, BOT, government grants, borrowing. I think we've covered most of those things. One important thing when it comes to 145A, and typically now it will come to books. There are certain credits which are blocked credits or ineligible credits. Those GST portions should be forming part of inventory even for your books purpose as well. Forget 145A. I have seen a lot of people missing on those aspects, because what happens is all those adjustments, say for example ineligible credit on purchases, now those are actually not clubbed as a part of purchases, which in turn will go for my inventory valuation. Those GST items are shown as separate charge to P&L. Therefore there is a high possibility that those kind of items would get missed in terms of your valuation of inventory. Therefore this is something critical which one should keep in mind when you are doing the audit. Also there is a possibility that sometimes even the custom duties which get missed, because those are paid separately. So block credits and custom duties on imported items is something which one should keep in mind while you are valuing the input inventory. Clause 15, capital asset converted into stock. While very simple thing, cost of acquisition while you report under this paragraph should be as per AS 10 or Ind AS 16, whatever applicable. But typical problem in case of non-corporate entities concerned, where you don't maintain fixed asset block and where you don't maintain depreciation block, there is a high possibility that identifying the cost of a specific asset which is converted into stock in trade and identifying a cost to that is very remote. So under such situations, one should be careful that how do you determine and how do you report those items here. Amounts not credited to profit loss account admitted by concerned authorities. Those have to be actually admitted by the authorities in discussions, or those show cause notices, or like, I mean, those kind of documentation will be very loose documentation to be amounts reported, for the amounts to be reported under this paragraph. So something which is where there is a concrete order, those amounts needs a reporting here. Now there is a high possibility that at the year end or before the year end, the orders would have been passed, but the refund may not have been issued. So what do? Do you wait the reporting for the money to be received? Answer is no. Here, confirmed, admitted, or rather admitted by the concerned authorities. The moment order is issued, it is admitted by the authorities. Therefore, the amounts become reportable here. Now here again challenge, the moment you start reporting under this paragraph, your ITR or your intimations will start picking up information from these paragraphs. Therefore, again, depending on what method of accounting you are following, one has to be careful in reporting here. Typically or largely, it should not be a problem if one is following mercantile system, because in mercantile system, the moment something is admitted by the authority, it is to be recorded as income. And if you report here, it does needs to be reported there. But what happens is, again, when we start with, and if we have recorded those amounts here, which are already forming part of my P&L, if any, of course, then if in that case it will not come here. So these are the ones which one should actually be coming in the P&L. I am not very clear if you are following a mercantile system, which are the line items which would not form part of P&L but income in the nature. So, but yeah, these paragraphs are there. Again, escalation claims, merely claims made or negotiations or claims which are under discussion may not need a reporting. The claims which are accepted by both the parties needs a reporting under this paragraph. Mercantile system of accounting needs to be kept in mind when it comes to books of accounts. Subclause D, any other income. Any other income, where do you stop for any other income? Does this include all and everything, being the income from other sources as well? Answer is, you should stop there. No, such incomes will not be reported here, because we are auditing for a business source. Items falling within that business chapter should be kept in mind while reporting under this paragraph. One should not go beyond that as far as this specific paragraph is concerned. But when it comes to next paragraph, capital receipts, there is a possibility that those will be some capital receipts which would form part here. But there again, my personal belief is that I will restrict capital receipts which are in the nature, which are falling in the business category. Therefore, capital receipts in the nature of gift or something, whether do I report? Probably I will not report the item of gift and all those things under this paragraph. So typically one may find a reporting under this paragraph if there are capital subsidies which are adjusted in balance sheet and not coming to P&L. Those may fall reporting here. Profit or loss on sale of fixed assets, typically it would be part of P&L, but if they are not and if they have been transferred to revaluation reserves or any such circumstances, then those would fall reporting here. Transfer of land and building value lesser than stamp duty, I think this is very simple, straight clause now. Only one thing one need to keep in mind when it comes to registered value or valuation, if something is not available on record while you are filing the tax audit report, you may involve some valuer and obtain those value, and depending on that you report. That is one. Second, what date you consider, whether the date of agreement which is made or registered date. So the answer is one should consider the value as on the date of agreement. If the registration is delayed, one should not look at the value on which the registration date the value was. So these are two typical points which one should keep in mind as far as this paragraph is concerned. Fixed assets, again simple, except for one critical adjustment when it comes to forex gain or loss, which is dealt in section 43A. Now under accounting standard 11, we can include forex gain or loss as a part of fixed assets, and there is also an opportunity available to book those forex gain or loss on long-term borrowings or long-term liabilities in P&L. So that possibilities are there as far as AS 11 is concerned. But when it comes to Income Tax Act, any forex gain or loss on account of long-term borrowing for fixed asset has to be adjusted in book written down value, meaning it will be always added or reduced from your block of assets. One more caveat here is only realized gain or loss has to be adjusted in block of assets and not unrealized. Therefore, if there are some unrealized gains which are in books of accounts which are adjusted to fixed assets, those unrealized gains will not form part of your block of assets. Those have to be removed. You have to maintain the reconciliation. As and when they realize, you will have to keep on adding to your block of assets. To that extent, your additions to books of accounts and your additions to Income Tax Act may differ. One such scenario. Another scenario where your additions to books of accounts and your additions to IT block may differ is the concept of ready to use and put to use. For books, the concept is ready to use. So the moment the assets are ready to use, the entity will capitalize, start amortizing or start depreciating. But if those are not put to use, those will not form part of block. Therefore, there could be a difference between books and IT as far as additions is concerned. So this is something which one should keep in mind while you are reporting for this clause. Old provision 1/4/2021, but again just keep in mind that goodwill is now not a part of block. That has to be adjusted. Employee benefit clause 20B, I think now it is very much settled. Lot of ambiguity or clarification in terms of employees' share if paid before due date, what used to happen. But I think now the law has been settled. It is very clear that those will not be allowed unless those are paid within the due date of the respective act and not before the filing of Income Tax Act due date. So that situation is settled, and I mean not much to discuss there further. Yes, because what happens is, as far as ESIC law is concerned, and if you see the challan, it is reflected in a different account number. PF and ESIC, if those are reflected, if those are paid on behalf of employee, the accounts are different. So those have to be reported. ESIC as well. ESIC as well. Clause 21 largely would deal with various deductions, and I think one of the important deductions is on account of fines or penalties. Otherwise settled, nothing much to discuss, but maintain a balance of fines or penalties in the nature of penalties and in the compensatory nature. So if there is something which is paid in the nature of compensation, it should not take the color of fines and penalties, and those should not be reported here. Compounding fees is something which people used to take a view that it is not in the nature of penalty, it is compensation, but I think the answer is clear now that compounding fees is in the nature of penalty, and same should be reported here. Also, there were some ambiguities, some expenditure incurred in violation of rules within outside India, but I think now it is covered. Anywhere you incur, those will have to be reported and those will be disallowed. And this clause also deals with disallowance on account of non-deduction of TDS. So any reportings are done under those clauses. Please make sure that necessary cross-referencing as far as clause 34 is done, because those amounts will get reconciled or those will get mapped with clause 34 as well in that table. Therefore, one has to be careful in mapping these two clauses. It'll go largely on the facts basis, but I think the principle what we'll have to keep kept in mind is whether it is in the nature of penalty or it is in the compensation. So that fact, very thin line. So that's what I'm saying. So that principle will have to be followed. The moment you say that this is penalty to be reported, the moment you say this is in the compensatory nature, not to be reported. So in amnesty scheme, if you as I have seen, there are generally always three components of coming clear out of those amnesty scheme. One is the principal liability, second is interest, and third is penalty. So very safely, I would say principal and interest should not be reported here, penalty should be reported. Definitely yes, because it is penalty. So these are certain items I said that these will be forming part of clause 21. These are so 40A3 disallowance is clause 21 reportable. I was about to take up this, but TDS on late payment of, interest on late payment of TDS. What do you do? No, it is allowable. It is allowable. Few years back, we used to take a view it is not allowable, but it is allowable. Actually, it takes the color of the expenses. What it say under under clauses 21, it says that income tax is not allowable. This is not income tax. Interest on TDS is not an income tax. In fact, TDS borne by the SSE, even that will be allowable. You can't disallow that. SSE should not be disallowed. So this is like grossing up. This is like grossing up. So one should not disallow. The requirement for disallowance of income tax is purely an income tax on my income, rather assessee's income. Now TDS or interest on TDS is nothing to do with assessee's income tax. Now if you talk of 234 A, B, C or say F or whatever those are, now those are interest on the income of the SSE, though they are collected separately 234 A, B, C, but they take the color of the income tax. Therefore, those may qualify for disallowances or reporting here, but not the interest on TDS. And there is recent Mumbai tribunal case law on this interest on TDS specifically. So that should not be disallowed. Because you are not claiming that as an expenditure. Clause 34 yes, but not here. See what happens is, that analogy of dragging that, so there was an analogy that in case of capital expenses, those are actually sitting in your fixed assets, and there is a depreciation on those fixed assets, whether those depreciation should be allowed or no. The answer is no, it is not getting dragged to, because there is a fine discussion happened that once something is capitalized, depreciation is by default. You don't have to incur it. You have not incurred for depreciation, you are getting allowed. So it is an allowance or an amortization. Therefore it doesn't trigger there. But clause 34, yes, you'll have to report. Clause 22, largely relevant for MSME, while the disallowance for non-payment of MSME covered in section 43B, but as far as tax audit report is concerned, it is not covered in that clause, it is covered here. Two important aspects as far as clause 22 is concerned: interest paid has to be disallowed. Interest payable debited to the P&L has to be disallowed. But what happens to the interest which is neither paid nor payable, or not booked as payable in books of accounts? So a big question mark there. If that is a scenario, I may question that whether my audit report should be clean or should it be qualified, because if those amounts are material, I would tend to qualify the report itself if no provision for interest on MSME is provided for. And the moment it is provided, it is forming part of your P&L, it stands disallowed here. So this is one important aspect as far as MSME is concerned. Another important aspect is disallowance for non-payments within 45 days or 15 days, depending on what kind of transaction it is. 45 days gets expired after 31st March, but the transaction was before 31st March. Say 1st March, 15th April, you are signing audit report on 30th June. Amounts are paid after 15th April, beyond 45 days. Whether this will be allowed in financial year 25-26 or 26-27. 26-27. I think that clarity is already there. So that is something which one should keep in mind. Typically, if you have not responded as negative, or you have not claimed, or you have not responded saying there are some defects in this service or goods, it is treated to be actual date of delivery of goods or services. That will be a deemed acceptance date. Or if you have claimed or created a defect or a liability against that transaction, then 15 days from the date of clearance of that defect or a liability. If you have not raised any objection as far as service or quality is concerned, that is by default. There is no specifically further to be taken anything there. So this will only be relevant if you have made payments beyond due dates because of some defects in services or goods, quality of goods. That's where this will be relevant. There you will have to create all necessary documents, and if you have those necessary documents to justify that those issues have been raised, then your liability shifts. Then those 15 days, 45 days starts after that has been cleared. Manufacturer and service, traders and wholesalers not. Again, small and micro, medium not. One important thing while reporting one should be careful is, if you see clause 22, first is simple clear. I have seen that people understand this as an arithmetic accuracy. So 2 requires total amount required to be paid to micro and small enterprise out of the amount referred to in 2 above amount A and B. Now A and B of 3 may not be equal to 2 is one should keep in mind, because the reporting requirements are different. So when it comes to 2, it says total amount required to be paid to MSME. So it has to be a total amount. And when it comes to 3, out of the amount referred into above amount paid up to time, which is say within the year also, if you've paid something after the time, whether those transactions will be reported in 3A, the answer is no. But whether that amount was reported in 2 above, the answer is yes. Because in 3B, you are only reporting the amounts which are inadmissible, and inadmissibles are the amounts which are outstanding at year end and not paid within 45 days. So be careful while what you are reporting in 3AB. The normal reading appears that 3AB should be equal to 2, but that's not the case. One will have to be careful in reporting. I think this is one important thing which we should be careful while we are reporting in clause 22. It is. Actually, there is no relevance. Actually, there is, frank, if you ask me in person, then this data is irrelevant. I mean, I don't know how is this data going to be consumed. Where are they going to use this? I think more important is 3B, because that's where there is an impact on SSC and department both as well. And that is what it was 1 year back. But last year this came and they have increased the responsibility. I'm sure they would have made. And I remember one discussion, one of my partner, with one of my tax partner in office. I think Chambers of Tax Consultant had represented this, and the response what they had straight got on their face was, you need not worry, this details is to be compiled by SSC, let them compile, you verify. One. Second, in case of corporate entities, you already have this information by way of form MSME, which the entities are filing half yearly. So exactly similar information you have there as well when it comes to corporate entity. There also they are, in fact, it's crazy. I don't know how many of us have seen MSME form. They are asking invoice number wise details there. So literally they are asking ledger there of the MSME vendor. Crazy details. But I completely agree and appreciate that actually there is no relevance of amounts which are reported into there, but that's what it is. No, that's what I'm saying. That's where the logic which I'm saying that 3A plus B should not be equal, may not be equal to 2. Can be, but may not be. See, the problem is we actually get away very easily by writing this. But as a standard of auditing, various essays, as an auditor, what is your responsibility? Did you, see, SSC says that I have not maintained any data of MSME. How much comfortable you would be in terms of reporting your statutory audit report in terms of 3CB when it comes to, it's not logical. Everyone would maintain some. Year one it is still okay, but now with so many years of history, if SSC is not bothering to send details or collect details of their vendors, whether they are MSME or no, I think I am doubting the intent of the SSC. Whether you want to get associated with those SSCs then, when there is no intent. I agree. But all of us know when MSME Act, the way MSME Act starts, notwithstanding anything in any law. So it is overriding all the laws in this country. It is overriding all the laws. I mean, easy rasta is we disclaim that the SSC has not provided and we have not done anything. But honestly speaking, there are a lot of tools available in the markets, paid ones. I can discuss offline which those tools are. You just give PAN number to them of your vendor, and I'm sure you will have PAN number of your vendor with you. SSC will have PAN number of vendor because they deduct TDS. The reports are available, who is MSME or not and under what category. So this is what I'm saying when it comes to additional audit procedures. Now, I don't know how will we as an auditor will convince our reviewers that I have not performed this additional audit procedure as an auditor. Yes, sir. Need to be tested. Needs to be tested. But when I'm saying data is available in the market, it is not in an illegal means. Huh? Those are proper vendors. There are proper vendor contract. I mean SLAs with those contracts. I don't know how is that getting backed and from where that data is they are getting pulled, but tools are available and official tools are available. Nothing, I mean illegal or dark web या ऐसा कोई उससे है. They have to register. I'm sure they must be collecting. So they must be having, they must have developed some APIs where they must be pulling data from those Udyam registration portal. So that would be definitely a legal way because a lot of large companies are helping this in this kind of data. But the point here is we as an auditor just cannot stop there. नहीं लगता है. नहीं लगता. It is only to manufacturer and services. Sorry? No. No traders manage. Yes. Correct. Correct. Now, are you disclaiming? Good that you raised point. I would have come to this in further paragraph. Are you saying that in case of statutory audit of a corporate entity, whatever reporting responsibility you have as far as Form 3CD is concerned, you will simply rely on the data what statutory auditor has done? It may not impact your taxable income. Yes, it may not impact your taxable income. Probably yes, because if something has not come in your P&L, short or excess either ways, it will get adjusted. So yes, but what they are trying to cover here is that whatever has come there, it has to be ensured that it is disallowed or it has been reported for disallowance purpose is the objective. But since you are on a topic that how much do I rely on the statutory audit? Now I was going to cover this in prior period items clause, which is relevant here as well now. So assuming if the auditor has not reported prior period item, will you say that no items are reported? I will still have to do, because as a stat audit, a tax auditor it's my responsibility to ensure whether the prior periods are done. Now as far as Ind AS financials is concerned, there is no prior period. Do you say the SS is following Ind AS, no prior period? I don't have no reportable items here, no. So whatever responsibilities we have as a tax auditor, we'll have to fulfill. You may start with statutory audit report, of course, yes. But if you find something different when it comes to your reporting is concerned, you yourself are responsible. You cannot rely on any other statutory auditor, because your materiality level for statutory auditor and you could be different. They may not find it material. You may find it material. You will have to report. Prior period, there is no materiality. It is a factual statement. So you have to do your homework well, is what I wanted to convey. Yes. Yes. So it is not person wise or entity wise. It is nature of services. So if it is a trading activity, not to be covered. Service, yes. So MSME, while fine, but actually it is only covering small and micro, not even medium. That is clarified. No. Manufacturing and service, not trading. I will cover. I'm just. So earlier it was 110 and 50, which is now 2.5, 25 and 125. But when you have taken the services, I mean, either bought a goods or a service from him, the transaction between you and that MSME is of trading and not service. I would take a view that it is a trading item and not to be disallowed. So while that MSME would have been registered under service category, but the transactions between the auditee and the MSME are of trading nature, one may still take a view. But you'll have to document all this. On what basis did you take this view? It's a good case to take a view. So whether payment timeline specified under agreement exceeds 45 days, we did discuss this is irrespective of 45 days. I mean, whatever timelines, it is maximum 45 days. Whether this applies to capex disallowance, the answer is no. Again, we discussed in some other clause as well. One typical issue, I mean, I've seen this practice. People will keep on issuing the checks on 31st March or before the 45th day, and those checks gets cleared 2 months, 3 months later. Good case to investigate. Good case to take a view. I'm not saying answer yes or no, but good case to take a view. These days, I mean, I would frankly speaking disallow, because these days, I mean, that SSE itself, generally 95% of the case payments are made through online port channel, and only to MSMEs which are outstanding at the year end they are issuing checks. Very good case to get disallowed. So be careful of those kind of situations as well, because this is what is happening. Sir. Largely you are a manufacturer. You would be practically not doing trading barring exceptional cases. So I would very risky to take a different view of taking it as a trading. Very risky, because when you would have, frankly speaking, sorry, trading can be discussed. But don't at planning stages, don't venture into all these things. If somebody is stuck, then maybe you think of all these things. But at the beginning, you don't venture into all this. Correct. It will be appearing in bank reconciliation. No, I will have a question. I mentioned that whether you want to give an opinion as true and fair view in these cases, where 99% cases the payments are through online channel, and only for these transactions the SSC has done this thing. Whether you really want to say your balance sheet is right, you are showing reduced bank balances instead of creditors. So now these facts let's discuss offline. It is getting recorded, but don't venture into these kind of things. And as an auditor, be careful of these aspects, because you'll have to justify these actions. Why have you considered this otherwise? As far as MSME is concerned, it is straightforward yes or no. And why I'm saying this is because the way MSME Act is actually starting, as I said, notwithstanding, so they are trying to, their objective is something different. So they are trying to overrule everything and trying to protect MSME. Why practically what happens to MSME, all of us know because of this law. But their objective was that, which probably has been misused. That's not a problem. I mean, again, you may have to go little drill down back, recourse, non-recourse, and all those things. So whether it's with recourse or without recourse, who is owning the responsibility? What happens if the creditor is not paying to the bank? Little more research there. So these are the revised. No, no, because you are paying tax on presumptive taxation. So under presumptive taxation, lot of deductions, addition, deletions are not to be considered. So this is one such item as well. No, then you are doing audit. Then yes. But if somebody is offering under presumptive, then, so as you do for 44 AD, whatever deductions or whatever allowances, disallowances you will consider, same logic will follow here as well for this section. For example, your depreciation will be deemed to be assumed, your this disallowances would be deemed to be assumed, and then you report a minimum threshold which is presumptive taxation in such cases. Related party transactions, again be careful and match with your financial statements, because I will come to QRB slide as well, where it has been observed that in financial statements AS 18 the transactions are reported, but 48 2B the transactions are not reported. So those kind of mismatches, be careful. The differences are possible because 48 2B only expects the reporting for transactions which are in the expense nature. So the capital transactions you may report in AS 18 but not here. Those differences are there. But at least the transactions in the nature of expenses should be reconciled between those two reports. 43B, nothing much. We are very much there except for MSME we discussed. 27A, again nothing much. Yes, sir. The section starts say so, payment to related parties, but typically the expectation is that you record expenses because that is subject to allowance or disallowance. Therefore, you will actually report expenses. So under Senvat clause, people are still reporting GST. The answer is no, GST shall not be reported. Purely Senvat, which was in the nature of excise, only those transactions have to be reported here. GST, ITC should not be reported under this para, is something what we should keep in mind. Prior period item, I wanted to highlight the point which we discussed few minutes back, like whether if the statutory auditor has not reported, then what do you do? What is your obligation as a tax auditor? So that is something which you should keep in mind. I think these are more of an academic clauses than the actual implication, except for 30B, thin capitalization is something which one should be keeping in mind. Make sure that you are doing necessary working when there are transactions with AEs. So those interest figures are properly calculated and only those amounts are reported properly here. Clause 31, again well settled clauses, but one observation, actually this clause warrants reporting for loans and deposits. Now largely I have seen the reporting only happens for loans, deposits are missed out. So all security deposits also will take the color of deposits which falls reporting under this clause 31 various paragraphs. So this is something which we should keep in mind while we are reporting under clause 31. Not required. But that clause itself says that transaction with the banking is not required. But of course, any excess reporting, I am still okay, I may not be okay something on something which was reportable but not reported. So as I said, security deposit is something which I have seen that is largely missed out. Very important. Yeah. The objective, I think when these clauses were introduced, there was a different objective. The amounts, the thresholds, 10,000 and 20,000, I mean those are, I mean I don't know what amounts they are. One more important point here is this cash. Now assuming there is a normal account where you are doing through on account pay transactions, and there is a one transaction, only one transaction of say 15,000 or say 25,000, 20,000 is the limit. Would you report? Yes, you would report. So those small aspects is something which one should keep in mind while reporting these paragraphs. Advance received for goods and services is not a deposit. Those are advances, so those may not require a reporting. Yes, sir. No, no, no. This is 269 SS, 269 T, 269 ST, and those sections. Brought forward losses and chapter 6A clauses generally comes out from the computation. So we tend to give a disclaimer that we have not verified the computation. It is the computation which is prepared by the SSC, and basis those computations we have reported the amount. So this is something which one should keep in mind. As per SF, I was about to say this. So one has to also keep in mind the litigations and assessments happened in the previous period, and one should appropriately discuss if there are differences between the carry forward losses by the SSC and the assessment orders. So those have to be clarified properly. Clause 34 again, cumbersome exercise as we discussed for other clauses, but we are used to now that exercise as well. One important thing here which we did discuss earlier was removal of section 206C TCS. So now 194Q will have an important role here. So that is something which one should keep in mind. Yes, sir. Typically as per books. Typically as per books, but including us and many other CAs, we frankly use this console files. So we request client to give the console files, unless I have seen while my audit, I have seen very unusual non-compliance or non-deduction. If that happens, then probably I would add. Why I'm saying this is required as far as books is concerned. Otherwise, those last columns of not deducted TDS का तो कोई relevance ही नहीं है. Because if you simply rely on TDS returns, you are then just copying paste the data. So this is required as far as books is concerned. But in case of voluminous data, you must still have a view that I would rely on test check basis. If you found something unusual, if you found something which where the compliance has not been happened, then probably you add those transactions. But at least your starting point would be those console files. Yes, sir. Doesn't apply. Yes. Answer is no, because the way you see that table, it says expenditure in the nature of 194C. That expenditure is in the nature of 194C, but TDS is not applicable by virtue of that circular. So there will be a difference between that first column and that second column. That's how it should be reported. C and yes. Correct. I appreciate. There's a difference in language. I completely appreciate that point. I mean, good point. I have never thought so, frankly speaking. Never thought so on this, but need to look into. But apparently, I would have taken a view that it should be because everything is coming from the books. But a valid point. We can check on this. I know, but as I said, console file is not the right way of approaching. It can be a starting point, but it cannot be a final conclusion. There's a possibility. There is a possibility for further questionings. Yeah, very much. Very much. There is a possibility. Inventory, I think we did discuss. Yes, sir. Mm-hmm. Correct. So something which is covered in those specific sections you will have to deduct, otherwise no. नहीं 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 नहीं. Not everything. You don't replicate your P&L here. You report the transactions which are in the nature of those TDS sections. The point which we were discussing is little more technical in terms of those fine wordings of that circular of the foreign shipping thing. But in general, you don't replicate P&L here, because there is a possibility from that same vendor you must be purchasing goods as well, and you must be taking some services which are in the nature of 194C. Now, do you report the whole amount? The answer is no. You report only amounts which are related to 194C. Yes, yes, 192. So inventory, we did discuss that maintenance of inventory. Now we cannot, I mean, it's not very easy to say that the SSC is not maintaining, keeping other laws in mind. So one has to be very careful while reporting this paragraph. Deemed dividend, बहुत simple, but उतना ही complex. To first identify what is the deemed dividend, because typically the deemed dividend triggers on the date of transaction. Now on that date, what were the accumulated profits, what were the reserves, how do you compute all those things, and how do you compute deemed dividend taxability? The answers are not very easy, but yes, any such situation you encounter, those kind of transactions are reportable here. Make enough working papers on whatever you are reporting under this paragraph, that how have you derived these values. Yes. Buyback of shares, I think this was the clause which was introduced last year. Otherwise, not a complication. So any buyback which has happened for such transactions, you have to report under clause 36A and B. I think it's very normal reporting. It's more of a factual reporting information which one has to do under buyback of shares, where amount received on buyback and what is the cost of acquisition for those shares which has been bought back. The only challenge what I see here when it comes to cost of acquisition is concerned, cost of acquisition for the purpose of income tax or cost of acquisition in books, because as some few minutes ago we discussed that cost for AS 13 and for ICDS securities is different. I would want to report, because this is relevant to income tax, I would want to report the cost of acquisition for income tax and not as far as books is concerned. But at the same time, I would also include an additional disclosure that cost of acquisition for this clause as per income tax is this, as per books it was this, to be on the careful side. I think the information that what are the audit evidence you collect, but these days a lot of information is available in ASTS for buyback. That is something which you maintain. Yeah, I think we've already discussed this. I would not want to discuss this clause. I think we are very much set, and I think we will need one more full session if we have to thoroughly discuss this. Everyone is following different practices. My request is whatever practices you are following, please give the note below your clauses that this is what we are following to compute these values. There are many such clauses. I mean, frankly speaking, I have not seen the tax audit report in New Act. I would be loving to see, I mean, whether these kind of redundant or unwanted clauses, whether they have ignored or not covered there. A few other important aspects of tax audit. I think we've discussed this in detail when it comes to financial statements of non-corporate entities concerned. One important point which I would want to highlight in case of NCE is, of course, there is a notification which is giving deferral. I mean, it is applicable to only limited sets of entity now and next year. Mind you, this benefit is applicable only for formats and not for following accounting standards. So just keep in mind that accounting standards for even those non-corporate entities are applicable the way they are. All this deferment has happened only for formats. So this is something which one should keep in mind while we are doing this audit. Sorry. Quickly on some important QRB observations, I believe Avinash bhai have taken and we also have discussed in the course of our discussion, but let me just quickly see if we've missed anything. Other law. Correct. So we can opt to. But the point here is what they have observed is the applicability was under some other section. It has been reported differently. So these are small things which we have to be alert in terms of while we are finalizing these reports. I mean, अपने को लगता है कि क्या ही फर्क पड़ता है, ऑडिट तो कर दिया, 3CD तो इशू कर दिया, ये सेक्शन ए लिखूं, बी लिखूं या सी लिखूं, क्या ही फर्क पड़ता है. बट this is how it shows that how vigilant we were. I'm sure not today, but sooner or later, disciplinary committee may take up these things. That how much negligent we are towards performing our duties is what these observations would show. Those small items, but this shows the involvement, like how involved we are in the process. So clause 20 ESIC was applicable to entity, but still there were no reporting there. I mean, they've really gone and spent time, and I'm happy this has come for tax audit reports as well. So far, the institute was only performing this on financial statements and not on tax audit report. But it's a very good exercise. One should look at, one should obtain this publication, look at these observations. This is really going to help us in our day-to-day practice. And whenever we do audit, we don't miss out on these smaller aspects. I mean, most of the aspects you will see, these are very minor in nature, but equally critical to show that how much importance we are giving to these kind of audit. And I think in this spirit, we have to go through this publication and implement. Management representation, we did discuss that it is not an evidence. I mean, though it cannot substitute evidence. It has to be an additional, which corroborates your existing evidence is something which we should keep in mind. DPDP we discussed at in depth. AI also we discussed. Couple of important things which has come up from this guidance note is the indebtedness paragraph. Like, we check all those parameters of indebtedness as far as applicability of auditors appointment is concerned, or eligibility of auditors is concerned when it comes to Companies Act. But similar provisions are there for income tax, tax audit as well, which we tend to miss. So just be careful on those aspects as well. Code of conduct gives a little higher amount as far as indebtedness is concerned. I think it is 5 lakhs. But when it comes to section 288 of Income Tax Act, there is no such limit. So even single rupee indebtedness may treat disqualification for we being an appointed as a tax auditor. So this is something which one should keep in mind. And come back again, sorry. how is auditee involved? Indebtedness towards auditee. So, sorry, towards the partnership firm. Partner theoretically may be okay, but for all practical purpose, I may not want to take that risk, because tomorrow somebody should not say कि directly or indirectly भी कोई drag ना करके जाए. Again, वो partner जो है उसका क्या share of profit है, how much stake he has in that entity, all those questions to be answered, but I would not tend to get into those. One should ignore, or if there are any such things, please clarify or please clear before you take those kind of assignments. Yes. No, 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 no. So good you raise this question. There is a tendency from the auditee side that they don't maintain two different balance sheets or two different sets of accounts. Their business transactions and their personal transactions are sitting in all one balance sheet. We don't accept those kind of things. We request SSE to redraw their personal financials and concerns financials separately, and we would limit ourselves only to the business entity and not personal asset. So there could be a possibility. So the classic problem which you will face while you are redrawing these two separate financials is the bank account. Where do you show the bank account? Now we'll have to see. Predominantly these transactions in this bank account are from what source? If those are business, then show that balance sheet in business account, route all the personal transactions through capital account and shift it there. Or if those are predominantly personal, then otherwise. But for sure, I am not going to certify the balance sheet which has got personal assets. Any more questions? All transactions. Yes, because in this new form 3CD, you have to report transaction wise, and whether that that specific transaction is through which mode. So there is a possibility that one transaction could be through check, the other could be through ECS, the third could be through NEFT, so on and so forth. Depends on how are you following the accounting. I would advise my clients that any interest payable should not be forming part of loan account. Park it in other interest payable or other payable. Why? Because the moment it takes a position in loan account, I will have to report in 31 A, B, C clause, 31 clauses, and since that amount has been created out of journal entry and not through those specified modes, I will say other than those specified modes, which may create a problem to the client. So I would request that park those interest payables in separate ledger account, unless these are credits which are going to get cumulated for next year's loan balance, and interest is also going to be charged on those loan balances. Then yes, park it in loan account. But otherwise, these are for, if those are for temporary settlements, then keep it outside the loan account. Sorry? So you are not taking, that interest payable is not coming in your loan account. So I will completely ignore that amount. No, that is not as far as loan is concerned. It is interest expense payable. So I will not consider that for the outstanding balance. I will only look at the loan account. Thank you everyone. Thank you for patience listening, and thank you for being participative. I really enjoyed the discussion.
Thank you, Yogesh Bhai. It was a very enriching and engaging session we had. Without wasting much of your time, I would request Ashwin Bhai, please give a vote of thanks.
Good evening, everyone. On behalf of Borivali Central CP Study Circle, I take this opportunity to thank our learned speaker, Yogesh sir. Thank you for giving rather than a technical knowledge, I would say a practical knowledge, so that we all can debate on each and every clause, Ind AS versus the ICDS versus the accounting standards, closing value of the inventories, and many such more things, wherein you shared with us that I personally take the printout of the tax audit report, have some more disclosure to it, which I cannot fit into those pre-filled technical things that is there, and upload it separately. So thank you very much for such an insights, which will help us all together. So I will request everyone to please join us for the huge round of applause. Thank you. Have a great evening.